9:30. Chicago's Morning Answer continues next on AM 560, The Answer.
Now, from the Signature Bank Studios, this is Chicago's Morning Answer with Dan Proft and Amy Jacobson on AM 560, The Answer.
Top of the morning, Dan and Amy. By the way, those people heading out of town in 8094 that Mike Scott were talking about, they are not coming back.
Oh.
They're just leaving. We have this housing affordability problem in the United States and in Canada, too. Pierre Poilievre, who is hopefully going to replace that gender-neutral grade school drama teacher they made their prime minister.
Yeah. Justin Trudeau.
He's
living the single life now, Dan.
Poilievre had a great response to the question of Trudeau's affordable housing gambit, and of course, it's government-centric in orientation. The government's going to build these houses, or they're going to marshal the process for construction and price setting, and so on and so forth. And that, to no one's surprise, is woefully underperforming, as central planning always does. Poilievre has an alternative approach if he were to win the day up in the Great White North.
It's a mathematical fact. He's not delivering. It's a mathematical fact that 9 years ago when I was housing minister, the average rent for a one-bedroom was $973. Now it's $2,000.
Oh, boy.
Right? These are the facts. Has he spent a lot of money on housing programs? Yes. He spent $89 billion on housing affordability, and the result is that housing costs have doubled. The problem is he's putting the money into bureaucracy. Government bureaucrats don't build homes. Private sector builders do. Government bureaucrats are in the way. So we need to get the government bureaucracy out of the way and deliver fast, affordable permits to build the homes. 1/3 of the cost of every newly built home in Ontario is government permits and taxes. 1/3. That's more than we spend on the labor to build the home.
Wow.
So we're spending more on the bureaucrats who don't build anything than we do on the carpenters, framers, plumbers, and electricians who build. Isn't that insane?
Yes.
Like when you buy a house, do you not find it incredible? You have this beautiful house, and you say, well, where did the money, I'm buying the house for, now it's $1 million. What does the $1 million go to? You know, you break it down, lumber, materials. You think more money goes to people sitting in government offices than goes to the people swinging the hammers, fitting the pipes, framing the lumber. It doesn't make sense. We need to cut the bureaucracy, and that's why my common sense plan will require cities free up land, speed up permits, cut development charges and fees as a condition of getting federal funds. If they don't hit my targets, they won't get their money, and there'll be less of those bureaucrats in those corner offices. So if they beat the target, they'll get more money. We're going to pay our municipalities the way we pay realtors and builders for the number of homes. Thank you.
That's how you make an argument. That's how you make a policy argument. Pierre Poilievre has the opportunity, if the Canadian electorate can see fit, to be North America's Javier Milei, as far as I can tell from this guy. Very impressive. That's the way you do it. And since we have the same problem, is that how we're doing it? Yeah, look at Chicago, where BLM Brandon's big idea is to turn the financial district into a housing project. For more on all this, Jim Perry joins us, founder, CIO, Perry International Capital Partners. Jim, thanks for joining us. Appreciate it.
Thank you, Dan. Good morning.
So, what do you think of Pierre Poilievre's prescription for the housing price issue for middle income families in North America? And yeah, is that what we're hearing from politicians at sort of the state and city level where housing prices are most pronounced?
Well, first of all, I think what he's saying is correct. I mean, the biggest problem with economies anywhere is that when government takes a bigger portion of it, you've got less and less productive growth coming out of those economies. So if you want the economy in any area, whether it's Ontario or St. Louis, let the free market work, right? Reduce regulation, reduce interference on delays and things, and let the economy work. Let supply and demand work. And I think that he's right, and I hope he wins.
I wanted to get I guess we'll talk. I mean, even I feel like we're required to talk about the jobs number every month, even though it's a number that has virtually lost all its meaning. But 272,000 jobs in May. So what?
Yeah, I mean, you and I have talked about this before. The revisions to these numbers are usually larger than the headline figures going back, and they revise them, 2 and 3 times. So it's a snapshot, Dan, of what the economy is doing. And I suppose that, everybody gets excited about it the first Friday of the month because, number one, it's the first data for May, right? So it gives you kind of a signal about the latest government report of how the economy is doing. It's a signal, and the market's really looking for a signal of whether or not the labor market is weakening because, as you know, rate hikes, which happened and started a couple of years ago, the Fed was thinking that the unemployment rate by now would be something like 5%, right? And it's not. It's 4%. And it's been I was looking at it this morning, the last time the unemployment rate in this country was 4.1% was sort of November of 2021. So we've been at 4% or lower for, 29 months. And that tells me quite simply that the economy is still doing pretty well. I mean, it's not universally doing well. There's different pockets. It's definitely different in South Beach than it is in St. Louis, but the fact is, on an aggregate basis, the employment situation is pretty good. 272,000 jobs, and again, probably revised down next month. But Morgan Stanley had come out, I guess, the other day that said, the number of jobs that you create a month to keep the unemployment rate steady at 4% is 250,000 jobs, and that's where we are. So I think the economy is still growing slowly, and the issue at hand, obviously, the number one issue for everybody listening to this show and to the voters and homeowners in this country is inflation, and that's still a problem.
Well, did you see the new News Nation Decision Desk headquarters survey they released that said 58% of registered voters are living paycheck to paycheck?
Yeah, I mean, I think that's been the case for a while. And I know it's alarming and it kind of concerns people, but I always say, Amy, averages hide more than they reveal, and the 58% of the people that they're talking about are the 58% of the people that really are living off of minimum wage, so or government support. So it's not surprising that number's kind of been there for a while, yet somehow consumer demand in this country is still rising, right? So we have to kind of balance all of these things.
And you also had NFIB, their economist came out and with their report, their monthly report, which is probably more interesting than the Labor Department's. 37% reported raising compensation for their employees. So these are the small businesses around the country. These are the real engines of job creation. That's historically pretty high, and another 1 in 5 plans to raise compensation for their employees in the next 3 months. Obviously it's a tight labor market. They want to keep their employees. It probably also signals that they're hopeful that inflation will recede at least a bit. People are, I guess, muddling along at a higher plateau than others.
Yeah, I think that's right, Dan. I mean, small businesses are in the crosshairs of government regulation and government fiscal spending, right? Households and small businesses are really suffering from higher costs. And a big part of the service sector of the economy, which is, almost 3/4 of output in this country, is wages, right? And wages are rising. And the reason for that, if you look at this this non-farm payroll number today, the biggest problem is that there's probably something like 1.5 million or 2 million jobs, fewer jobs today in the economy than there were pre-pandemic, right? So the labor market is still imbalanced, and inflation is rising faster than essentially home incomes, right? Disposable incomes are falling because inflation is rising so high, and insurance and taxes are rising high too. So the small businesses and households are falling further and further behind. And to Amy's point, the people that are living paycheck to paycheck, that number is not going to get any better anytime soon, right? You're talking about 58% of the population. These are real numbers, right? So there's a reason why when you look at these national surveys that, optimism really isn't going up, it's going down.
What's this move of Wall Street from New York to Texas? Citadel and BlackRock taking their balls and moving to Austin?
I think it's interesting. I've seen the story. I know who's behind it, and we all know the reason why, right? I mean, New York City, the New York Stock Exchange and the NASDAQ, their costs of doing business are going up too, right? And they have to pass those price increases to someone else. So if the financial services industry, which is, the biggest industry in the country here really right now, along with tech, if Citadel and some of these larger organizations that are taking larger and larger portions of the brokerage business on their platforms, if they can move to a low tax, low regulation state, that means their profit margins go up. So I'm not so sure it happens anytime soon, and I think there's a lot to it. But the fact is that it's a signal in that business, like many others, is that businesses and households are struggling under higher costs of doing business. And if you move from New York to Texas, you're doing okay.
And it's not just that; it's also, and I think this is a political arbitrage play, but it's also sending a signal to some of the Marxists, some of the anti-capitalist capitalists at NASDAQ who want to impose ESG in order to be listed on the exchange and so forth, right?
Correct.
I mean, this is basically a shot across the bow. Knock it off. We'll take your exchange away from you by setting up a new one in Texas.
Yeah, that's right. It's a shot across the bow, and the ESG and the carbon thing and the sort of inclusive sort of thing. It's a regulation, right? So if you can get away from those regulations, your cost of doing business goes down. It's pretty simple.
All right, so give us, I always like to get up, since you're an expert and a professional in the space, I always like to get, and you're so forthcoming, I'd like to get your sort of portfolio balance,
Right.
because, a lot of people say, well, you can't fight City Hall sort of with respect to the manipulation of the market to go ever higher. And so at least through the end of this year, as long as things appear to be stable, at least on the surface, we should see equities provide a continued return if for no other reason than NVIDIA.
Yeah, correct, Dan. I mean, I always put my portfolio on the front page of the weekly strategy report because if you know what I own, you know what I think, right? It's pretty simple.
Yeah.
The fact is, portfolios should be defensive because the reasons we're here are not sustainable, right? I mean, the NASDAQ, just to kind of give you an idea of what's going on here, the October lows, the NASDAQ's up 36% in sort of 6 months. NVIDIA's up 200, right? So the stock market is highly concentrated, and much of the returns in the NASDAQ, I think the NVIDIA is responsible for, there's an index, the top 100 NASDAQ companies. NVIDIA is responsible for something like 35 or 40% of the return of that index. And that's very dangerous. The market's extremely concentrated. I also saw the other day that, in that sort of 100 top NASDAQ companies, even in this rally, 60% of them are up which is great, and that's kind of been broadening out the last kind of couple of weeks here. But 40% of them are losing money, right? So even in the NASDAQ 100, the concentration is ridiculously narrow. And I think if you look at this is a little bit nerdy, but there's a market cap weighted index of stocks in the NASDAQ, and then equal weighted one. And the large cap stocks, the market cap stocks, are up something like 13.5%. And the equal weighted index, these are the same stocks, right? That's only up 3%. So, this is unusual, and it's dangerous because you're looking at kind of a 3 standard deviation event here. It just doesn't stay this way forever. Now, having said that, back to your question, really, the stock market is probably going to be just fine between now and the election, because if we get a down trade like we had in April, 5%, 6%, and it's June or July or August, right before the Democratic convention, August in Chicago, you'll probably get more fiscal stimulus. So that's what the market's betting on. I had a meeting with a hedge fund neighbor of mine yesterday, and these guys are very quantity and process oriented, And I said, why do you think the stock market is here, and why do you think it's going to stay here through the election? And he said, well, it's simple. Hedge fund thinking is, what are the odds of a rate hike between now and the election? And I said, well,
Zero.
Right. Right. So it's zero. So he goes, hedge funds take tail risk away. So if rate hikes between now and November are zero, the odds are zero, then who cares whether people think the Fed's going to cut or stay here? The fact is, money is going to stay cheap, and it is cheap, right? I mean, 5.5% on the Fed funds rate. If you go back to, post World War II, since 80 years ago, since D-Day, right? The average yield in this country on borrowing money at the federal level has been 6.5 or 7%. It's 5.5. And you get this narrative every single day from Wall Street and the government that, the Fed has raised rates at a higher rate than ever recorded in history. And I kind of go, well, yeah, but they were at zero for 7 out of the last 14 years. I mean, rates are still low. And the Fed doesn't really understand that. The government doesn't want to address that. And Wall Street doesn't care, because government likes inflation, Wall Street likes inflation. And really, money remains cheap for the broad, large economy. And that's why it's still expanding. And the big trouble is, that's why it's still inflating. That's the biggest problem. Prices continue to rise because of fiscal stimulus.
Jim Perry, founder, CIO of Perry International Capital Partners. James, thanks as always. Always informative. Appreciate it.
Thank you, sir. Have a good weekend. Amy, thank you.
Thank you. And he joined us on our turnkey.pro answer line.
It's news, opinion, insight. This is Chicago's Morning Answer on AM 560. The Answer.
Hi, it's Sean Thompson here.